For decades, the largest American bank stood as a symbol of economic strength and stability. Built on trust, innovation, and massive scale, it weathered crises, steered markets, and helped shape modern financial systems. Yet, its eventual downfall is a cautionary tale about greed, unchecked ambition, mismanagement, and the ripple effects of economic instability. This video provides an in-depth look at the pivotal moments, internal missteps, and external pressures that took this financial juggernaut from the pinnacle of success to utter collapse. Number 5. The rise. A pillar of American finance, Titan Bank's rise to dominance was marked by a combination of strategic foresight and timely decision-making. In its early years, it aggressively pursued mergers and acquisitions, absorbing smaller regional banks to expand its presence nationwide. This growth allowed it to establish a vast network of branches, positioning itself as the go-to financial institution for businesses and individuals alike. During pivotal moments in American history, such as World War II and the implementation of the New Deal, Titan Bank formed key alliances with governmental agencies, providing essential financing for war efforts and infrastructure projects, further embedding itself in the country's financial framework. Its investment in technology during the 1990s proved to be a game-changer as the bank became a leader in the digitization of banking services, offering innovations such as online banking, automated teller machines, ATMs, and secure digital transactions. By leveraging its size, reach, and technological prowess, Titan Bank not only accumulated vast assets but also solidified its reputation as a financial giant with unparalleled influence in both domestic and global markets. Number 4. The zenith. Dominance in the modern era. By the early 2000s, Titan Bank had solidified its reputation as a financial juggernaut. With total assets exceeding the trillion-dollar mark, it dominated the banking sector both domestically and internationally. Its vast network of branches spanned across nearly every U.S. state, ensuring its presence in every major city and small town alike. The bank's success was rooted in its pioneering approach to financial services, notably becoming one of the first major institutions to fully embrace online banking, providing customers with unprecedented access to their accounts through user-friendly websites and mobile apps. This innovation extended beyond retail banking. Titan Bank became a titan in investment banking, handling high-profile corporate loans, mergers, and acquisitions, while establishing itself as a major player in bond trading. Its extensive portfolio of credit card offerings, mortgages, and personal loans catered to a wide array of consumers, solidifying its grip on the market. Internationally, Titan Bank embarked on a rapid expansion strategy, opening branches in key financial hubs across Europe, Asia, and South America. Its global reach allowed it to compete head-to-head with European banking giants such as Deutsche Bank and HSBC, leveraging its size and resources to penetrate new markets. This global expansion, however, introduced significant complexities. Although the bank's diversified portfolio appeared to offer a buffer against risk, it also concealed the growing vulnerabilities within certain divisions. As Titan Bank pursued aggressive growth strategies and complex financial instruments, it unknowingly laid the groundwork for future instability, with cracks forming in areas such as subprime lending and leveraged corporate loans, which would later expose the institution to systemic risks. Despite these looming challenges, the early 2000s represented a period of unparalleled growth and influence for Titan Bank, a behemoth whose footprint was felt across the world. Number 3. Cracks in the foundation. Warning signs. As the 2008 financial crisis loomed, the groundwork for Titan Bank's unraveling had already been set in motion. The bank's expansive real estate portfolio, once viewed as a pillar of strength, had become a liability due to its significant exposure to subprime mortgages. Like many of its peers, Titan had aggressively pursued these high-risk loans drawn by the short-term gains that the housing boom promised. However, as defaults began to spike and the housing market started to collapse, Titan found itself holding a vast amount of toxic assets. Compounding this vulnerability was its increasing reliance on complex and opaque financial instruments, particularly credit default swaps, CDS, and collateralized debt obligations, CDOs. These exotic derivatives, designed to spread risk, instead concentrated it within the bank's balance sheets. The astronomical profits generated during the boom years masked the growing financial black hole these products were creating. Internally, Titan was plagued by systemic corporate mismanagement. Senior executives, motivated by the pursuit of short-term profits, encouraged aggressive risk-taking while overlooking the need for stringent oversight. Reports from within the bank revealed that risk controls were either weak or entirely absent, with divisions often operating in silos, unaware of the mounting dangers across the institution. This culture of complacency and unchecked ambition allowed risky practices to go unnoticed or ignored until it was too late. When the financial crisis erupted, Titan Bank was caught flat-footed, unable to unwind its exposures in time. Although the U.S. government stepped in with a bailout to stabilize the bank, the damage was already done. Public confidence in Titan Bank began to wane as customers and investors alike grew wary of its practices. Despite surviving the crisis, the institution was left severely weakened, with its once unassailable reputation now in tatters, setting the stage for deeper problems to emerge in the years to follow. Number 2. Post-2008. Survival, but at a cost. In the aftermath of the 2008 financial crisis, Titan Bank managed to remain standing, but it was a shadow of its former self. Government bailouts provided the necessary liquidity to prevent collapse, while sweeping restructurings aimed at tightening risk controls and improving transparency. Regulatory reforms, driven by the Dodd-Frank Act, imposed stricter oversight on Titan, forcing it to unwind some of its riskier operations. However, these efforts could not undo the profound reputational damage that the bank had suffered. In the years following the crisis, investigations uncovered widespread fraudulent activity within Titan's foreclosure practices. Thousands of homeowners were improperly foreclosed upon, often without due process, resulting in multi-billion-dollar settlements and fines that further eroded the bank's public standing. At the same time, the broader political and public sentiment was turning against too-big-to-fail institutions like Titan. The bailouts, though necessary to stabilize the financial system, ignited a wave of populist anger, with many viewing these institutions as emblematic of unchecked corporate greed. Titan found itself at the center of this fury not only because of its role in the financial crisis, but also due to a series of high-profile public relations scandals. Revelations that top executives had received lavish bonuses during the bailout period were met with widespread outrage. The public saw these payouts as evidence that Titan had learned little from the crisis and continued to prioritize profit over accountability. Despite these mounting challenges, Titan Bank pushed forward, determined to recover. Under new leadership, the bank initiated a series of reforms aimed at rebuilding trust, focusing on ethical lending practices, customer engagement, and corporate responsibility. New products and services were introduced, including initiatives to support small businesses and sustainable investments. While these moves helped the bank regain some of this lost ground, they also placed immense pressure on the institution to return to profitability at any cost. The very strategies meant to rebuild Titan, cost-cutting measures, expansion into high-growth markets, and increased reliance on technology, exacerbated internal tensions and masked the long-term vulnerabilities lurking beneath the surface. As Titan Bank sought to reinvent itself, it inadvertently laid the groundwork for its eventual downfall, with the seeds of destruction sown amidst its desperate efforts to recover. Number 1. The downfall, a perfect storm of missteps. The collapse of Titan Bank was a complex unraveling of internal missteps and external pressures. Internally, aggressive cost-cutting measures aimed at boosting short-term profitability severely backfired. By laying off thousands of employees and outsourcing key operations, the bank inadvertently undermined its operational efficiency, creating gaps in service and oversight. Its digital transformation strategy, once hailed as innovative, quickly turned into a disaster. The bank rushed into adopting artificial intelligence and automation technologies without sufficient testing or security protocols, leading to a series of data breaches and prolonged service outages. These issues not only eroded customer confidence but also invited scrutiny from regulators and the media. Furthermore, a whistleblower's revelations of a toxic corporate culture revealed an environment riddled with unethical practices, excessive risk-taking, and weak leadership, compounding the bank's vulnerabilities. Externally, Titan Bank's overexposure to emerging markets, particularly China, left it especially vulnerable as the global economic landscape shifted in the late 2020s. Trade tensions, particularly between the US and China, hit the bank hard, as did fluctuating currencies and unpredictable market conditions in the regions it heavily invested in. Meanwhile, regulatory bodies, still cautious after the 2008 financial crisis, implemented stringent rules that curbed Titan's flexibility. Mounting fines for regulatory violations drained the bank's resources. The rise of fintech competitors only worsened the situation. These new-age companies offered streamlined, tech-driven services that appealed to younger customers, stealing market share from Titan Bank at a critical juncture. By the time Titan found itself in a liquidity crisis in 2030, it was already too late. The bank's plummeting stock prices and loss of investor confidence sealed its fate, leading to its eventual collapse. Thanks for watching. Don't forget to like, comment, and subscribe for more.